There is a number inside your CPF account that nobody talks about. Your employer will never mention it. The government will not send you a letter when you cross it. And most Singaporeans, including people earning very good salaries, have absolutely no idea it exists. But the moment your combined CPF balance crosses $100,000, something quietly flips. The math changes. The rules of the game change. And from that point forward, the heavy lifting is no longer being done by you. It is being done by your money. Today, I'm going to show you exactly what happens at that threshold. Why two Singaporeans earning almost identical salaries their entire careers can retire with completely different amounts, and what you need to do the moment you get there. Let us start at the beginning. Because for the first few years of your working life, CPF feels like a scam. You watch 37% of your monthly paycheck disappear. 20% from your own pocket, 17% from your employer. Straight into this account you cannot touch. You log in once. You see a small number. You log out. You do not log in again for 6 months. Maybe a year. Maybe longer. Because the balance barely moves, and staring at it feels like watching paint dry. Here is the thing though. That feeling is not laziness. It is not a character flaw. It is mathematics doing exactly what mathematics does in the early stage of compounding. When you have $20,000 in your CPF and the interest rate is 4%, you earned $800 that year. 800. That is less than 1 month of employer contributions for anyone earning a decent salary in Singapore. Your contributions are doing all the work. The interest is a rounding error. So the brain does what brains do when something feels pointless. It stops paying attention. People start treating CPF like a tax, money that disappears from their salary and never comes back, instead of the most powerful retirement vehicle most of them will ever own. They stop checking their balance. They forget which allocation they are in. They wake up at 45, look at the number, and realize they have sleepwalked through 2 decades of the most important compounding window of their lives. And this is precisely where Singaporean retirements diverge. Not at 60, not even at 50, right here, in their 30s and early 40s. When two people earning almost identical salaries make completely different decisions about whether to pay attention. Now, here is where it gets interesting. At a balance of $100,000, a 4% return on your special or retirement account generates $4,000 in a single year. $4,000 added to your account while you are sleeping, while you are eating chicken rice at a hawker center, while you are stuck in the MRT during peak hour doing absolutely nothing productive. And your ordinary account is meanwhile adding another $2,500 at its own rate. With the bonus interest on the first $60,000 of combined balances, your total passive CPF earnings at $100,000 start approaching $7,000 a year. $7,000 without working a single extra hour. That is the tipping point. That is the moment CPF stops being a tax and starts being a second income. But here is something most Singaporeans do not fully appreciate, and it is the reason CPF absolutely destroys every savings account, every fixed deposit, and almost every retail investment product for money you are parking long term. Your CPF earnings are taxed at 0% while they compound. 0. The Singapore government taxes individual investment income at their full marginal rate. But growth inside CPF sits in a completely different world. It compounds clean, year after year, untouched. The 4% in your special account is not 4% minus tax. It is 4% full stop. And once you hit $100,000, that tax-free compounding starts doing the kind of work that takes your breath away when you model it out over 20 or 30 years. So what do you do if you are sitting at $40, $50, $60 or $80,000 right now? You push hard to cross that line as fast as legally possible, because every year you delay hitting 100,000 is a year stolen from the back end of your retirement, where the growth is enormous. Here is how you actually speed it up. The first lever is your special account top-up. Every Singaporean citizen and permanent resident can make a voluntary cash top-up to their own special or retirement account of up to $8,000 per year and get a full dollar-for-dollar tax relief. Top up $8,000 for yourself and another $8,000 for a family member, a parent, a spouse, and you have $16,000 in tax relief in a single year. For someone in the 15 or 18% tax bracket, that is more than $2,000 in actual cash saved on your tax bill, on top of the money now compounding at 4% inside CPF. This is genuinely one of the most underused and highest return moves available to any Singaporean earning a decent income. The second lever is your Supplementary Retirement Scheme, or SRS. Think of this as CPF's quieter cousin, a voluntary account where Singapore citizens and permanent residents can park up to $15,300 per year, get full tax relief on every dollar contributed, and invest that money in STIETFs, Singapore REITs, bonds, or unit trusts through DBS, OCBC, or UOB. The growth inside SRS is tax-free until you withdraw, and when you do withdraw in retirement, only 50% of what you pull out is counted as taxable income. Which means if you withdraw $40,000 a year, the first $20,000 is tax-free, and the other $20,000 sits in the lowest possible tax bracket. Done correctly, you can pull years of retirement income out of your SRS account at an effective tax rate of almost nothing. One critical detail that most people overlook: the statutory retirement age in Singapore rises from 63 to 64 on the 1st of July 2026. If you open an SRS account before that date, your qualifying withdrawal age locks in at 63. Open it after that date, and it locks in at 64. 1 year of difference in when you can access the money tax-free. A small thing, but the kind of small thing that is worth knowing. The third lever is the most important one that costs you nothing and takes 15 minutes. Log into your CPF account this week and look at exactly where your money is sitting. How much is in your ordinary account, doing 2.5%? How much is in your special account, doing 4%? If you're under 55, you can transfer funds from your ordinary account to your special account, and that transfer is irreversible. But it is the kind of irreversible that quietly compounds into tens of thousands of extra dollars by the time you hit 65. The gap between 2.5% and 4% might sound like 1.5%. Over 30 years on a significant balance, it is the difference between two very different retirements. Now, a quick word on the bigger picture. Because in 2026, the full retirement sum that you are targeting, the number you want locked into your retirement account by age 55, is $220,400. If you set aside that full amount at 55, it will grow to roughly $325,000 to $330,000 by the time you turn 65, purely from compounding interest inside CPF. Your CPF LIFE payout on the standard plan then starts at $1,780 a month for life, guaranteed by the Singapore government regardless of how long you live. And if you push all the way to the enhanced retirement sum of $440,800, that guaranteed lifetime income jumps to over $3,400 a month. Here is the bonus play that less than half of Singaporeans take advantage of. You do not have to start your CPF LIFE payouts at 65. You can defer them up to age 70. And for every year you wait, your monthly payout increases by up to 7%. Defer the full 5 years, and your payout goes up by up to 35% for the rest of your life. Over 1 in 2 Singaporeans who qualify are already choosing to defer, because the math is simply that compelling. So let me bring this all the way back to where we started. The gap between two Singaporeans who earn nearly identical salaries their whole careers, but retire with completely different amounts, is not luck. It is not timing. It is not which company they worked for. It is the decision they made, or failed to make, in their 30s, about whether to take CPF seriously before it got interesting. Because here is the brutal truth. CPF is not interesting when you have $20,000 in it. It is extremely interesting when you have 100,000. And it is life-changing when you have 200,000. But you cannot get to 200,000 without pushing through the slow, boring, seemingly pointless early years when the balance barely moves. The Singaporeans who win this game are not the ones who made the highest salaries. They are the ones who understood what was happening inside that account early enough to stay disciplined, make the top-ups, move the money to the right places, and then, crucially, stopped touching it and let it run. Log in this week. Look at your number. Make the top-up if you have not done it this year. Check if your OA to SA transfer makes sense for your situation. Open that SRS account before the 1st of July 2026 if you have not already. Because in 20 years, you will not remember the month-to-month noise. You will only remember the day you finally understood why everything changes after you hit $100,000 inside your CPF. If this video opened your eyes, hit that like button and subscribe. Share it with someone who has been ignoring their CPF statement, because now you both know why that needs to change. See you in the next one.